Hello again, clients and friends. This is Billy Doughty, Doughty Financial. My pleasure to present our second quarter economic update for 2023. At our firm, we partner with clients and believe an educated client is our best client. While we will always try our best to help you, when it comes to your finances, we believe that knowledge is power. One of our missions is to share with clients any knowledge that can better help them make an informed decision. The second quarter of 2023 continued to test even the most seasoned of investors. It was a quarter that included the U.S. reaching a debt ceiling agreement, the Federal Reserve pausing their aggressive interest rate hikes, and bank failure fears starting to subside. During the quarter, equity markets continued to defy odds by staying strong, and the major indexes ended the second quarter higher than they started. The S&P 500, led by a handful of large tech stocks, rose 8.3% during the second quarter, logging its third straight quarter gains. The S&P 500 closed the quarter at 4450, ending the first half of 2023 up 15.9%, for its best half since 2019. The Dow Jones Industrial Average ended the quarter up 3.4%. With the support of mega-cap tech stocks and the artificial intelligence buzz, the S&P 500 officially began a new bull market in June, rising over 20% from its low in October 2022. However, some analysts are saying we are not yet out of the woods from a possible downturn. In the second quarter, we saw an easing of inflation. In May 2023, prices increased by 4% compared to 8.6% in May of 2022, according to the 12-month percentage change in the Consumer Price Index, or CPI. Although it was not reported until July, which is after the quarter's end, in June the Consumer Price Index was up 3% from a year ago, the lowest level since March of 21. On June 1st, the Senate passed a major debt ceiling measure, suspending the nation's debt ceiling and putting caps on federal spending until January of 25. The U.S. was on the verge of a major default, and this bill has helped stave off this potentially catastrophic crisis by raising the amount of money the government can borrow. In response to the slowing of inflation, after a very aggressive 10 consecutive interest rate hikes, we saw a much anticipated pause in June. As of June, the Fed funds rate was 5 to 5.25%. Most recently, at the start of the third quarter, the Feds raised the target rate range to 5.25 to 5%. As of June 30th, 5-year Treasury notes yielded 4.13%. 10-year notes yielded 3.81, 20-year notes 4.06, and the 30-year note is at 3.85. Typically, longer-term bonds have higher yields than shorter-term bonds, but as we can see, this is not currently the case. Since April of 2022, we have experienced what the industry refers to as an inverted yield curve, which means longer maturities provide a lower yield than shorter ones. Many analysts share that historically, this can be a strong indicator that a recession is pending in the next several months. Other analysts remind us that there are other factors to consider, including job reports, wage growth, and inflation before determining if a recession is imminent. Safety comes with a cost, and many major banks are still averaging low interest rates to savers. According to Barron's, the average bank money market rates on June 26, 2023 were still only 0.32%, and the average 12-month CD rates was 1.7%. While higher than a year ago, these are still low returns. If you have questions about higher returns, please call our office. The much discussed recession has not yet affected equity prices, although some reports speculate that we will absolutely experience one in the coming months, just as many believe we will not. Obviously, no one can completely tell for sure what will happen, and if so, at what level of severity. Should the U.S. experience a recession, one of the best ways to prepare is to remain financially liquid. This means that you should make sure you can meet all your current financial obligations. You should also anticipate and prepare for any large cash obligations you foresee, such as funding a wedding, helping family members, or purchasing a new vehicle. On troublesome days, it can be helpful to avoid too much exposure to the media and the news. It seems like many of the news reports are no longer there to inform the viewer, but rather to incite fear in the viewer. Media magnification can cause anxiety and even cause investors to make emotionally charged decisions, which typically are not the wisest. We stand by our belief that investing in equities is a long-term commitment. Investors can expect to continue to face a challenging market environment and the need to look at long-term stability and quality. Practicing patience and proceeding with caution are key to your financial savviness. Multiple factors remain key players in the direction of equity markets, most particularly interest rates and speculation of if, how long, and how deep a recession in the U.S. could be, and the global economy in 2023 and beyond. As your financial professional, we're committed to keeping you apprised of any changes in activity that could directly affect you and your unique situation. Once again, seasoned investors understand that equities are long-term investments and that long-term investing is not linear, and it requires patience and discipline. Staying the course and maintaining the consistency of a well-devised, long-term focused plan has historically served investors well. As a recap of quarter two, here are some things to remember. It's possible we will see one, if not two more interest rate hikes in 2023. While the S&P 500 is officially in a bull market, this is not a time to become complacent. The cost of borrowing is still elevated and interest rates are still on the rise. Don't forget to continue to pay down any debt that you may have and try not to incur any more during the higher interest rate environment we're in. It is always wise to live within your means and minimize any borrowing, but it is recommended now more than ever. Review all income-producing investments as uncertainty remains. Remember that all well-balanced portfolios should be designed to have resilience in times of volatility. This is an ideal time to practice patience and to remain focused on your personal long-term goals. Inflation is slowing down, but still well over twice as high as it was at the 2% rate that the Fed target is. Refocusing and revamping your budget can help you save from unnecessary spending and provide clarity on where your money is going, what is a necessary expense, and what is discretionary. Should a recession happen, we want you to be prepared. Having a solid investment strategy is an integral part of a well-devised holistic financial plan. We help clients create a well-crafted plan customized for their unique situation and goals that takes into consideration how each client will react to the ups and downs. We consider many variables including your time horizon, tax implications, liquidity needs, risk tolerance, and overall personal objectives. Again, caution should still be the principal notion for investors. And as always, we are here for you. As stewards of your wealth, we are here to help you pursue your goals. If you'd like to revisit your financial plan or discuss any concerns or ideas, please call our office or bring them up at your next scheduled meeting. We're very grateful for our clients and appreciate the opportunity to partner with you in your financial journey. One of our goals is to help more people just like you. The best compliment is a referral. Some of our best clients were referred to us by existing clients. If you know someone you think may benefit from our services, we would appreciate their contact information so we can add them to our distribution list to receive our newsletters and so we can invite them to attend our presentations. Again, thank you for your business. One of our primary goals is to keep clients informed, and we appreciate you watching our update. Please call if you have any questions.